Hello, I'm Liam Donohue from Lennox Capital Partners, and today I'll be taking you through a portfolio update. In terms of a very brief reminder, firstly, in terms of how we invest at Lennox and how we view ourselves as differentiated, we have on the slide in front of you a few key points that we thoroughly believe in. The firstly is alignment. James and I own the majority of the business. We have all of our personal wealth outside of our family home invested in Lennox. So we are well and truly on the journey alongside all of our investors. Secondly, research. Everything we do is led by our own hands-on fundamental research, and that will result in long-term investments within the portfolio that we are convicted in. And lastly, conviction. We typically only hold around 30 stocks in the portfolio, so you do have a very concentrated collection of our best ideas only. So moving over the slide, and I do want to touch on this performance slide for a moment. I'll say up front that we are and have always been benchmarked against the Small Ordinaries Index, but as you probably all know, there's quite a lot of mining and energy exposure in that index. And that's a part of the market that we don't invest in because we don't feel that you can forecast the earnings of those businesses. And forecasting earnings is a big part of what we do in our investment process. So we also include here the Small Industrials Index, which is for comparison purposes only. But you can see the relative performance on the bottom line of the table against the Small Industrials. And over the medium to long term, you can see that we've been able to add 3 or 4% above that index after fees very consistently. And that is exactly what we'd expect given our risk budget. Over 1 year, you can see we're roughly in line with that index. And then very pleasingly, you can see on a very short-term view, our 1 month number for February saw us deliver some really strong outperformance through reporting season. Now, if you shift up a couple of rows, you can see that the relative numbers there versus the Small Ordinaries Index is soft, but that takes into account what has been a 20% plus headwind over 1 year from mining and energy. And that is as extreme as James and I have ever seen in 20 odd years of managing money. So a very, very stiff headwind at the moment. But the positive out of that is that when we look back through history and analyse the performance of the small resources versus small industrials, which are effectively the two subcomponents that make up the Small Ordinaries Index, we know that those two parts of the small cap market broadly deliver the same return through time, but resources do it in a much more volatile way than industrials. And that makes sense when you think about mining being a really cyclical industry. So resources have had a good run, particularly gold, but history tells us that those booms will invariably turn into a bust at some point. And that may be starting to happen as we've seen gold really sell off over the past few weeks. We won't be calling the top just yet, but it may be the start. So while resources are and have been a material headwind for us at the moment, history does say that that won't last. So if we move over the slide here, we won't labour this one, but this is our longer term performance versus the Small Ordinaries. And you can see that those compounded returns over the long run have delivered some very comfortable outperformance versus the Small Ordinaries through time. And that is despite that very extreme headwind that we have seen from small resources over the past 12 or 18 months. And finally, then on this slide, we have a reminder of our investment process and how we invest within the Australian small cap market. Now, this is the same process that we've used throughout time, and there is absolutely no change to that process in light of the current cyclical headwind we're seeing from mining and energy. So absolutely no change to our investment process. But firstly, as we've covered previously at Lennox, we are bottom-up stock pickers. We're fundamental analysts. And to carry out that work, all we need is an idea. Now, more often than not, those ideas come from direct company engagement and external research, but we also do have some more quant-based screens to supplement those ideas if we need them. Secondly, once we've got the idea, the first piece of work that we carry out is a really detailed quality assessment of a company, and we do that early on to make sure that the business that we're potentially going to invest a lot of time and energy into doing the work on is effectively worthy of that time and of that commitment. And what that results in is a quality bias in terms of the companies that we're researching and investing in, and that has certainly served us well over the very short term, which often we do see in periods of extreme volatility. But month to date through March, we are comfortably outperforming the market, and we often see that again during volatile markets, because what investors scramble for at that point are quality earnings and quality business models, which we think we have in spades. Then thirdly, if the business passes through that quality screen, we carry out really detailed research on the company to try and understand as much as we possibly can about them. Also where the business is heading over the medium to long term, which is a real focus for us. And we also really want to understand the people running the business, because they can absolutely be critical to small companies and whether they succeed or fail. And ultimately that culminates in earnings forecasts and modelling that help us judge the valuation of that business and hopefully deliver an outcome that shows some significant upside to valuation over our investment horizon. Lastly, portfolio construction is broadly a risk management tool for us, and we very much try and manage issues like liquidity and our risk budget across the portfolio. So on the slide in front of us here, we've got some of our top holdings at the end of February, and we're very happy to talk to any of these individual stocks during our Q&A session. But briefly to touch on a few of them, we have a pre-IPO position in Firmus, which is working towards a listing over the next few months, and we're very positive on that business. We've obviously covered that one in a bit more detail previously, but we do also have a stock summary of that business on our website if anyone is interested in doing a little bit more reading on that business. But again, also happy to talk to that one in the Q&A session. Superloop is another top holding for us. They're a challenger telco and an NBA brand, NBN brand, NBA on the mind, that's doing really good things in the Australian market. And NRW Holdings is a contracting business. As Jimmy mentioned, there is quite a volume of work available to contracting businesses at the moment, and NRW are absolutely at the forefront of that. They've performed really well in recent times, and they are in a bit of a golden period in terms of the sector, but that business more generally, and we do view them as one of the really high quality operators within the contracting sector, so we're very comfortable with that position. So I might leave that there for the time being, but that is a taste of some of our top holdings within the portfolio as at the end of February. Now, on the current slide, we've got some top and bottom contributors for the past quarter, so the past 3 months. The front of the list, we've got there Firmus, again, the pre-IPO position. That business has made some really positive developments over recent months as they're working towards that IPO. Then we've got the drilling tech services business, Imdex, and Imdex has done a really good job of streamlining their own business over the past few years while the drilling cycle has been in effectively a downturn or a slowdown. And now that the cycle seems to be turning upwards quite strongly, Imdex are really well positioned to enjoy some pretty strong operating leverage there as volume or revenue starts to come through that business. And then thirdly, NRW Holdings, obviously we just touched on that one, but they have seen a really strong period of contract wins and earnings growth, importantly, as Jimmy mentioned. They've also had a clever acquisition in there as well, which has driven some inorganic growth. Then on the flip side, we've got corporate travel. We actually marked that value down during the quarter, so that obviously impacted on returns. And then we have Life360 and Zip, which have both been caught up in the sort of growth/software sell-off. But in the case of Zip, they also had an earnings disappointment in February, which warranted some of that share price pullback. So again, we're very happy to touch on those in a bit more detail if they are of particular interest. And now on the next slide, we've got some recent portfolio changes through the quarter. Firstly, we did participate in a fairly modest way in an additional funding round for Firmus. That was just before Christmas, so we topped up that position a little bit then. We also topped up our positions in the other three names there, being Judo, Lovisa and Superloop, broadly driven by the valuation upside that we saw in all of those names. And that did serve us well through reporting season, particularly for Superloop, which delivered a really strong result in February. And even though it had been soft in the lead up to that result, the market is well and truly back on board with that business now, and the share price has performed really well and continues to do so. And then I suppose on the flip side, we haven't listed them on this slide, but through the quarter, we were very conscious of taking profits and locking in gains in many of our names, given the market was running so strongly. And that meant that we built up a little bit of a cash reserve by the end of February. Now, we're not macro investors. We don't take views on the market or where things are heading. But obviously that has served us well coming into March, with the market selling off quite aggressively. But we wouldn't give ourselves a pat on the back for calling that market sell-off. Clearly, we, like everyone, didn't see that coming. But it is, I suppose, a positive in that we were very disciplined in terms of taking profits when they were there, and not just letting positions run and inflate. We were very disciplined to make sure we had the right size positions for the valuation upside that we saw in all of those holdings. And that has resulted in a reasonable cash balance in and through March, which, as James mentioned, we are looking for opportunities to deploy that cash balance into. So it does feel like the market's sort of coming to us on that front. But we will continue to be very diligent in terms of the businesses that we're looking for.